Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now, based on our latest research.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show.
Yeah, absolutely.
And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's start the countdown. What's the first company on our list?
Okay, first up is Nebius Group. The reason it's standing out is, well, frankly, the sheer velocity of its growth. It's driven by its position as a critical AI infrastructure provider.
Right.
You look at the past year, and the stock appreciation is just staggering, 481.8%. I mean, that doesn't happen without some really intense, sustained market demand.
Yeah, that number definitely grabs your attention. But, as we always stress, growth without efficiency, that's just spending money fast. We need to look a bit deeper, right, into the financials.
Exactly.
Specifically, how is a high-growth company like this, an infrastructure company, actually maintaining profitability?
Well, that's the fascinating part, isn't it? And kind of where the strategic advantage really shows itself. If we look at their operational metrics, their trailing 12-month revenue, so what they've brought in over the last year, it's strong. $249.3 million. But the real kicker here is the net profit margin, 76.29%.
Wow. 76%.
Mm-hmm.
In the AI build-out sector, I mean, that's highly competitive.
It is.
That kind of margin suggests they aren't just selling, a commodity service. They must have some highly defensible IP or maybe a pricing structure with some serious leverage.
Mm-hmm.
It does raise the question, though, is this sustainable? Or maybe just a one-time thing from early contracts?
That's the core tension for investors right now, absolutely.
Yeah.
Market seems to believe in the sustainability largely because of those massive validation contracts, the most notable being that huge $17.4 billion foundational AI infrastructure deal they landed with Microsoft.
Okay, yeah. That's serious validation.
It really validates their competitive position on a global scale.
It does. But we have to balance that excitement with, the capital demands, right? Scaling up to meet contracts that big costs money.
Correct.
Their near-term negative free cash flow, sitting at nearly $659 million, tells that story. They're investing heavily in expansion right now.
Right.
And just for anyone unfamiliar, free cash flow, or FCF, is basically the cash left after operating costs and capital spending. Yeah. Negative means they are burning cash currently to fuel that future growth.
Precisely. It's a classic high-risk, high-reward bet. The analyst consensus remains a strong buy, but all eyes are on the upcoming Q3 earnings release. That's November 11th.
Okay.
The market isn't just looking at revenue. They're waiting for management's guidance, specifically on the timeline for that negative FCF to turn positive, and also what they're doing to manage that extreme share price volatility we've seen.
Agreed. So the key takeaway for Nebius seems to be huge leverage to the AI boom, but success hinges entirely on, flawless execution of those massive complex contracts.
That's a great pivot, actually, because flawless execution in high-growth sectors bring us right to our next pick.
Interesting. Okay, my pick for the next one is NextNRG. This one is all about sector leadership and, strategically riding that whole energy transition wave.
Right, NextNRG. They've established themselves as the leader in mobile fueling, but the real story now is their aggressive move into the future of energy, isn't it?
Absolutely.
Yeah.
They've built a solid moat in mobile fueling, sure, but the exponential upside, that's really in their strategic shift toward these high-growth areas, specifically wireless electric vehicle charging tech, and advanced battery storage solutions. They're fundamentally transforming their business model, becoming a much more diverse energy logistics provider.
And we're actually seeing that transition start to show up in the numbers. Their recent preliminary revenue for September hit $7.07 million. That represents a huge 229% year-over-year growth.
Wow.
This isn't just, small steps. This suggests they might have hit a kind of tipping point in scaling these new ventures.
And critically, they seem to be showing financial discipline while achieving that kind of geometric scaling. They did a targeted financial restructuring that managed to cut their monthly cash burn by $1 million.
That's significant.
Yeah, when you're tracking a growth company, efficiency moves like that. They're often just as important as the revenue gains. It shows management is serious about achieving, operational leverage down the line.
Right. That reduction in cash burn is a really significant marker pointing towards profitability. And it seems analysts agree. We're seeing a strong buy consensus with some pretty dramatic price targets, ranging from $5.50 up to $6. Considering their recent price was around, what, $1.79? That's a potential upside of 170 to 200%. Pretty substantial.
Yeah, the confidence is clearly rooted in the future potential of that wireless EV charging tech. The main catalyst here, the thing to watch, is the Q4 update. That's scheduled between November 12th and 14th. Investors really need to see proof that the initial operational growth is sustainable and that those new contracts are, in fact, translating into better margins. That's what justifies those steep price targets.
Makes sense. Okay, so we've talked infrastructure, we've talked energy. Let's shift gears a bit to disruption. Next up, we're looking at a major fintech disruptor, Robinhood Markets. This company has just been on an absolute tear, performance-wise.
It really has. Yeah, the stock is up over 290% year-to-date in 2025. And this success, it's not just market hype. It really feels like a confirmation of their dominant position with a very valuable and fast-growing user base.
Absolutely. Their moat is pretty much tied up in millennial and Gen Z investors, right? We are talking about a platform that now holds 26.5 million funded customer accounts.
Huge numbers.
Yeah, and total platform assets are approaching $279 billion. That asset base grew nearly 99% year over year. That kind of asset accumulation, especially in the current market, is extremely impressive.
But the key strategic insight here, I think, is that they can't just rely solely on commission-free trading forever. That feels like a strategic masterstroke, really.
How so?
Well, they're using their massive young customer base and that strong brand loyalty to enter traditional, high-margin banking products. It dramatically increases their total addressable market.
Yeah, that expansion significantly mitigates the risk of just being, a volatile trading app. Now, volatility is still a factor, though.
Oh, for sure.
We noted that the options market was anticipating a potential 9.4% price swing around their Q3 earnings release, which was just on November 5th.
Right, and that high anticipation, it speaks volumes about the market's focus on new product announcements and guidance.
Definitely.
If they announce a successful rollout of a mortgage product, or if those persistent international expansion rumors actually materialize, the stock reaction could be pretty outsized. The risk, of course, is whether they can really penetrate these traditional markets effectively. I mean, they have the users, sure, but do they have the actual lending expertise? That's the question.
That is the right question to ask. Okay, moving from fintech disruption to the underlying hardware that's kind of driving a lot of this, my next pick is Supermicro.
Supermicro. Yeah, they are firmly establishing themselves as a kind of pure play AI infrastructure leader.
Right.
Which means they're providing the custom hardware that powers companies like, Nebius and enables the AI models that Upstart uses. They're sort of the engine room for this whole AI race.
And their moat seems to be their proprietary modular architecture. They can integrate the newest chips, leveraging those deep ties with suppliers like NVIDIA, and get customized server and storage systems out to market faster than competitors. That speed is just crucial in the AI world.
Yeah, absolutely crucial. And that speed translates directly into the financials.
Right.
Their fiscal year 2025 revenue hit nearly $22 billion. That's a 46.6% year-over-year increase.
Wow.
And maybe more importantly, the future pipeline looks massive. They have a reaffirmed backlog of design wins that exceeds $12 billion. That really confirms the demand isn't just some flash in the pan.
Okay, now there was a minor hiccup, which we should probably address for balance. There were some Q1 fiscal year 2026 revenue deferrals. Can you explain what that means and maybe why it didn't completely derail the stock?
Sure. Right. Deferrals simply mean revenue from contracts got pushed into the next quarter. It was basically a timing issue, not a cancellation of orders.
Okay.
And management immediately stepped in and reiterated their massive full-year target of $33 billion. The market tends to forgive timing issues like that when the long-term pipeline is that strong. It suggests the execution risk is, manageable.
Gotcha. So the next major execution checkpoint is clearly the Q2 earnings announcement. That's late January 2026. The market will be watching closely to see that deferred revenue actually materialize and to get confirmation on that full-year target.
Exactly. And we also need to highlight their expansion efforts. The creation of Supermicro Federal, which is dedicated to penetrating the very lucrative U.S. federal IT market, that's a significant move.
Why is that significant?
Well, that diversification into government contracts adds a layer of potential long-term stability and, frankly, a massive, predictable new customer base. It's a smart strategic play.
Okay, interesting. All right, rounding out the list, let's circle back to fintech innovation and talk about Upstart Holdings. The narrative here is really all about using technology to solve a fundamental problem, assessing credit risk better than traditional lenders can.
Exactly. Their technological moat is their proprietary AI lending platform. Traditional lending relies on pretty limited data points, FICO scores, things like that.
Hmm.
Upstart's AI uses a much wider range of non-traditional data to provide, theoretically, a far more accurate and nuanced credit risk assessment. This allows them to approve a broader range of borrowers, often at fairer rates, driving growth in segments that traditional banks might overlook.
And we are finally starting to see that technological advantage mature into, well, sustainable profitability. Their trailing 12-month net income recently turned positive, $32.21 million. Furthermore, their forward price-to-earnings ratio is 20.31.
Yeah, that PE ratio is key. So let's just unpack it simply for a second. The price-to-earnings ratio basically tells you what the market is willing to pay today for a dollar of future earnings.
Right.
So a forward PE of 20.31 implies that the market is expecting significantly higher future earnings. They're betting on Upstart's ability to scale that AI model rapidly, probably through more bank partnerships.
And the analyst sentiment certainly seems to support that bullish view. The consensus 12-month price target averages $74.73. That suggests an upside potential of over 60%.
It does.
But the risk, I suppose, is whether that model really holds up under a serious economic downturn. It hasn't truly been tested through a major recession yet, has it?
That's the critical uncertainty, exactly. Their model needs to prove its superior accuracy through various economic cycles, especially, during periods where default rates might spike.
Mm-hmm.
That's why their upcoming Q4 2025 earnings preview around November 15th and those persistent rumors of potential new bank partnerships are so important. New partnerships would instantly accelerate their loan origination volumes and further validate the model in the market's eyes.
Right. So it's a high-stakes play, really, on the belief that better data ultimately beats traditional intuition in lending. The more bank partnerships they secure, the wider that competitive moat gets, making it much harder for anyone else to catch up.
A fantastic breakdown. Yeah, we've covered quite a bit, everything from the backbone of AI infrastructure to the cutting edge of consumer finance and energy tech.
So to recap, our 5 stocks to watch are Navius Group, Next NRG, Robinhood Markets, Super Microcomputer, and Upstart Holdings.
A solid list. Covers AI infrastructure, clean energy, fintech disruption, and AI-driven lending. I think the central thread connecting these 5 is really their superior technological moat or clear market leadership in these hyper-growth sectors. As always, do your own research before making any investment decisions. Thanks for tuning in.